It has been a nervous start for the markets to the calendar year 2023. While the Sensex has been range-bound between 59,000 to 63,000 over the past 3 months, the Nifty has oscillated between 17,600 and 18,800 during this period. Both benchmarks have been underperformers as compared to their global peers thus far in 2023. Analysts believe this muted performance comes after a good run in 2022 and is partly attributed due to the fear of a global recession and the ensuing central bank policy action. Moreover, the developments with the Adani Group back home have also kept the mood in check. Expensive valuation, according to Siddharth Bamre of Religare Broking, is another headwind.
Nifty, in fact, if you look for investors, this market is in range since September 2021. And for positional traders who have time horizon of 15 days to 1 month, this market is in a range since last 5 months. And even for short-term traders, last 1.5 month, barring that 1 day, market is hovering around this 18,000 levels. And there are specific reasons for that. Firstly, interest rate is the main concern which people have, and now with fresh data coming of US inflation and even the job data, which is clearly hinting towards that Fed would continue to hike its interest rates, and that would make equity less attractive if bond yields are higher, and hence we are seeing that markets are stuck in range. Though the problem of inflation and interest rate is not so much related to us in India, and that's the reason 2-3 months back we have seen our market performing very well. Now valuations are a bit expensive, and they were much more expensive a couple of months back. Now we have seen a bit of correction. If you look at the earnings season which has crossed us or is crossing, we haven't seen any major positive triggers. So yes, there is still gap between the way market is and where the valuations are. We might see some more time correction. And mind you, if the inflation numbers and the inflation data comes this way from US, then we may further see some correction. But as of now, the best case scenario for us is that this time consolidation for all the participants might continue for some more time.
In a recent note, analysts at Elara Capital noted that FII's country rotation to China and ongoing liquidity withdrawal too pose headwinds to the markets. However, the sustained strength in earnings, they said, could provide downside protection to the markets in the near term, keeping them range-bound for some more quarters. Against this backdrop, what could be a good investment strategy that one can adopt in this range-bound market? Bamre of Religare suggests this to investors.
Such kind of consolidation, it is always that you be sector specific or stock specific, and we have certain sectors which have done really well, and we believe that they might continue to do well because the earnings support is also there. So firstly, if you look at FMCG space, we have ITC, Britannia under our coverage who have done well, and we have recently upgraded their targets. So these are few names in FMCG space which will do well. Even from cement space, we are liking Ultratech Cement and Dalmia Bharat, and cement. Apart from capacity expansion, we are now seeing that input cost pressures are coming down, and this space can continue to do well. The other space which we are liking is auto. It's not a defensive space, but then the kind of monthly numbers which you are seeing coming from, especially four-wheeler segment, is pretty encouraging. Within this space, the market leader Maruti, which has now series of products getting launched in after hiatus of 4-5 years, will see its underperformance of last 5 years go.
ICICI Securities meanwhile suggests investors use corrections to buy stocks of companies that have lean balance sheets, are capital efficient, and possess growth longevity. It says Nifty earnings are seen growing at a CAGR of around 15% over FY22-25. We retain our Nifty target at 21,500, valuing the index at 21 times PE on FY24-25 average Nifty EPS of 1,020 rupees. Therefore, adopting a stock-specific approach seems to be the ideal strategy in these market conditions as per analysts. On Wednesday, the markets are likely to remain range-bound amid the lack of any significant triggers.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.